The headline sounded like a miracle. $100 billion in new investment. A massive partnership to restart the largest oil reserves on the planet. A promise to flood the market with cheap crude and lower gas prices for every American family. On paper, the president's plan for Venezuela looks like the deal of the century. It promises to solve inflation. It promises to secure energy independence. It promises to turn a failed state into an economic ally. But if you look away from the podiums and look at the tickers on Wall Street, you see a different story. The smart money is not celebrating. The smart money is running for the exits. When the news broke, ExxonMobil didn't jump. Chevron didn't promise to double its spending. The major energy indices barely moved. Why? Because in the world of high finance, there is a golden rule. Never confuse political ambition with economic reality. What we are witnessing right now is not the beginning of an energy boom. It is the construction of a financial trap. 'Tis a capital destruction machine that is being sold to the American public as a solution to high gas prices. Today, we are going to ignore the politics. We are going to ignore the diplomatic speeches. We are going to focus entirely on the math. We are going to show you why pouring $100 billion into Venezuela is the most dangerous financial decision the energy sector could make. We are going to explain why this plan will likely trigger a wave of bankruptcies among independent oil companies. And most importantly, we are going to show you why this deal will not lower the price of gas at your local pump. In fact, it might make it go up. If you have a 401k, if you have a pension fund, if you invest in energy stocks, you need to understand the risk that is being baked into the system right now. This is the economic shockwave that no one is talking about. The Wildcatter's gamble. To understand the danger, we first have to look at who is actually going to Venezuela. We know who isn't going. ExxonMobil has effectively said no. They have fiduciary duties to their shareholders. They have risk committees that analyze every penny of capital expenditure. They looked at Venezuela, saw the legal risks, saw the infrastructure rot, and decided that the return on investment was negative. So if the giants are staying home, who is the president talking to? He is talking to the independents. The Wildcatters? These are smaller, private oil companies. They are aggressive. They are hungry, and right now, they are desperate for a win. In the oil industry, the Wildcatter is a romantic figure. They are the risk-takers who built the Texas oil boom. But in finance, high risk often equals high default rates. Here is the economic trap that is waiting for them. These smaller companies do not have the balance sheets of Exxon or Chevron. They do not have $50 billion in cash reserves to weather a storm. To fund a massive project in Venezuela, they have to borrow money. They have to go to the debt markets. They have to issue high-yield bonds. Right now, interest rates are not zero. Borrowing money is expensive. So, picture this scenario. A mid-sized American oil company borrows $500 million at a 10% interest rate to drill in Venezuela. They deploy the capital. They hire the crews. They ship the equipment. But then reality hits. They find out that the pipelines they need to use are corroded and need 2 years of repairs. They find out that the local labor force has evaporated. They find out that the legal framework for exporting their oil is still stuck in court. Suddenly, that $500 million is stuck. It is sitting in the ground, generating zero cash flow. But the interest payments on their debt do not stop. Every month, the bank demands its cut. Every month, the clock ticks louder. For a company like Exxon, a 2-year delay is a nuisance. For a Wildcatter leveraged to the hilt, a 2-year delay is a death sentence. This is exactly what happened in the subprime mortgage crisis. We encouraged people who couldn't afford the risk to take on massive debt to buy an asset that was overvalued. Now, we are encouraging companies that can afford the risk to take on massive debt to drill in a failed state. We are setting up a subprime energy bubble. these companies default, who holds the bag? American banks, American bondholders, American pension funds that bought those high-yield bonds chasing a return. The president is selling this as a job creation program. But the math suggests it is actually a bankruptcy creation program. We are inviting a wave of defaults that could destabilize the entire independent energy sector. And for what? The refinery bottleneck. Let's assume, for the sake of argument, that the Wildcatters succeed. Let's assume they somehow navigate the chaos and start pumping oil. This brings us to the second economic lie, the promise of cheap gas. The narrative is simple. More supply equals lower prices. It is Econ 101, but the oil industry does not run on Econ 101. It runs on chemistry. And the chemistry of Venezuelan oil is a nightmare. Not all oil is created equal. The oil that comes out of the ground in Texas, the Permian Basin, is what we call light, sweet, crude. It is like champagne. It is easy to refine. It flows easily. It turns into gasoline with very little effort. The oil that comes out of Venezuela is different. It is extra heavy crude. It is like molasses mixed with sulfur. It is thick, toxic, and incredibly difficult to process. You cannot just put Venezuelan oil into any refinery. You need specialized equipment. You need complex cokers and hydrocrackers designed specifically to break down those heavy molecules. Here is the problem. For the last 5 years, while Venezuela was sanctioned, U.S. refineries adapted. They reconfigured their plants to process more domestic light crude. They invested billions in optimizing for the oil we produce right here in America. Now, the administration wants to flood the system with Venezuelan sludge. The refineries in the Gulf Coast cannot just flip a switch. To process millions of barrels of heavy Venezuelan crude, they would have to shut down for maintenance. They would have to retrofit their equipment. They would have to spend billions in capital upgrades. Who pays for that? The refinery owners are not charities. If they have to spend billions to upgrade their plants to handle this new oil, they will pass that cost on to the consumer. This is the hidden tax in the president's plan. The cost of refining Venezuelan oil is significantly higher than refining Texas oil. It takes more energy. It takes more time. It creates more waste byproducts. So, even if the raw cost of the barrel is lower, the cost of the finished gallon of gasoline might not drop at all. In fact, introducing a massive stream of incompatible crude into the U.S. refining system could cause bottlenecks. It could reduce overall efficiency. And in the energy market, inefficiency always leads to higher prices. There is another cost factor: logistics. Moving oil from West Texas to a Houston refinery is cheap. It goes through a pipeline. Moving oil from Venezuela to Houston involves tankers, involves insurance premiums for entering a politically unstable zone. It involves loading and unloading fees. It involves the risk of spills in the Caribbean. Every single one of those steps adds pennies to the price. When you add up the refining complexity, the transportation costs, and the insurance premiums, the cheap Venezuelan oil isn't so cheap anymore. It is a discount product with a premium price tag attached to its processing. The American driver is being sold a bill of goods. They are being told that quantity equals savings. But in this specific case, the quality of the product destroys the economics of the savings. The inflationary boomerang. There is a concept in economics called opportunity cost. It basically means if you spend $1 on plan A, you cannot spend that same dollar on plan B. Capital is finite. Talent is finite. Equipment is finite. The $100 billion the president wants to send to Venezuela has to come from somewhere. It is not magic money. It is money that would otherwise be invested elsewhere. And elsewhere usually means the United States. Right now, the U.S. energy sector is in a delicate balance. Production in the Permian Basin is growing, but it requires constant reinvestment. Shale wells deplete quickly. You have to keep drilling just to stay in the same place. If we divert capital, drilling rigs, and petroleum engineers to Venezuela, we are starving our own domestic industry. Every drilling rig that is shipped to the Orinoco Belt is a rig that is not drilling in Midland, Texas. Every specialized engineer who flies to Caracas is an engineer who is not optimizing wells in North Dakota. We are essentially cannibalizing our own energy security to chase a mirage abroad. This creates the inflationary boomerang. By starving the U.S. domestic sector of capital and talent, we could cause U.S. production to stagnate or decline. U.S. shale has been the only thing keeping global oil prices in check for the last decade. If we weaken U.S. shale to prop up Venezuela, we lose our leverage. We lose our swing producer status. If U.S. production drops because capital has fled to South America, global supply tightens. When global supply tightens, prices spike. So, we could end up in the worst of all possible worlds. We spend billions in Venezuela and get very little oil in return because of the infrastructure problems. Meanwhile, we neglect our own fields, causing domestic output to drop. The result? Less total oil on the market, higher prices for consumers, and a massive destruction of American capital. This is the definition of a bad trade. We are trading a proven, stable, high-quality asset in Texas for a broken, risky, low-quality asset in Venezuela. No rational investor would make that trade. That is why the government has to push so hard, because the market refuses to do it voluntarily. And this brings us to the inflation risk for the broader economy. Energy is an input cost for everything: farming, manufacturing, shipping, retail. If this Venezuelan adventure destabilizes the energy market and causes a price spike, inflation comes roaring back. The Federal Reserve has spent 2 years fighting to get inflation down. They raised interest rates. They caused pain in the housing market. They cooled the economy. Now, a reckless energy policy could undo all of that work. If gas hits $5 a gallon because we broke the domestic supply chain, the cost of groceries goes up. The cost of Amazon deliveries goes up. The cost of building a house goes up. The $100 billion plan is not just an oil policy. It is a potential inflation trigger, the pension fund trap. Finally, we need to talk about who really pays when this goes wrong. When I say American companies might go bankrupt, it sounds abstract. It sounds like a problem for millionaires in boardrooms. But who owns those companies? Who owns the debt of the independent oil producers? Who owns the banks that lend them money? You do. If you have a pension, if you have a 401k, if you have a mutual fund, you are the silent investor in this gamble. Pension funds are constantly searching for yield. They buy corporate bonds. They buy energy stocks. If a wave of mid-sized oil companies default on their debt because their Venezuelan projects failed, those bonds become worthless. The pension funds take the hit. The retirees take the hit. We saw this in 2015 when the oil price crashed. Dozens of companies went under. Billions of dollars in shareholder value evaporated overnight. But that was caused by market forces. This crisis would be caused by government policy. We are incentivizing companies to take risks that they shouldn't take. We are luring them into a financial graveyard. And when they collapse, the damage will ripple through the retirement accounts of teachers, firefighters, and office workers across America. It is a transfer of wealth from American savers to a Venezuelan money pit. So, let's summarize the scorecard of the $100 billion mistake. First, it lures vulnerable companies into a debt trap that could lead to bankruptcy. Second, it floods the market with heavy, sour crude that raises refining costs rather than lowering them. Third, it diverts capital away from U.S. domestic production, threatening our energy independence. And fourth, it risks a new wave of inflation that hurts every single consumer. The president says this is about lowering gas prices. The math says it is about destroying capital. As an investor, or just as a citizen, you need to be aware of the difference between a slogan and a strategy. A strategy acknowledges constraints. A strategy respects the laws of chemistry and finance. A strategy protects the home team before gambling on the away team. What we are seeing is not a strategy. It is a gamble. And unfortunately, we are all putting chips on the table, whether we want to or not. The next time you hear a politician promise that Venezuelan oil is the solution to our problems, remember the opportunity cost. Remember the refineries in Texas that can't process it. Remember the wildcatters who are about to lose everything. And ask yourself one question. Why would we leave the gold mine in our own backyard to dig in a minefield somewhere else? The answer isn't economics. It never was. I'm curious to hear your take on this. Do you think American oil companies should risk bankruptcy to follow a government directive? Or should they stick to the geology and economics they know in the US? Let me know in the comments. These are the kinds of financial realities that usually get buried under political shouting matches. My goal is to dig them up so you can protect your own interests. If you found this analysis useful, consider subscribing. We are going to keep tracking the money wherever it leads. Thanks for watching, and I'll see you in the next video.